Market slightly weak today. Here's Nigel with the world view.
Well, the bond yields came back to haunt the equity traders yesterday because the yield went down all the way to around 2.35%. That's the lowest we've seen since December 2017. The equity markets as well, all three frontliners ended in the red. But if you look at the Dow, that was a relative outperformer in comparison to the other two. Couple of stocks in there did well. Apple, that was the lone stock from the FANG stocks that did end with some green. It ended with a gain of around 1%. So that's what supported the Dow. And the second stock that did well was Boeing. They said that they have put up some fixes in terms of the issues with the Boeing 737 MAX plane. So on the back of that, we had Boeing as well that was up close to around 2%. That's the highest weightage in the Dow, and that's what helped the Dow be the relative outperformer in yesterday's trading session. But we'll move on then. In fact, we move to the European markets. They ended in the red yesterday. In fact, they ended as flat as can be. There was some commentary that came out in yesterday's trading session as well. You had the ECB chief, Mario Draghi. He said that a slowdown doesn't really mean that we're heading into recession. That was an encouraging statement that came out of there. Theresa May, the report suggested that she may be in to give up her resignation and give up her position as of now in return for Brexit. So that's something that we'll be tracking very, very closely. And also we had a whole host of stocks that were in focus. You had Commerzbank that was up close to around 5% in reaction to its annual report. The CEO has taken a price cut as well out there. Stock was up 5%. Fiat Chrysler, well, they say that maybe they could be a takeover candidate, so that was up nearly around 3%. And Knox Hydro was up close to around 3% because progress in terms of reopening their alumina smelter, that did continue. The dollar index, in actually, that's an incorrect rate. It's closer towards 97 odd, so keep that in mind. The yen has shown some strength in comparison to yesterday. Because the yen is strengthened, that's why the Nikkei is the big underperformer today. That's down close to around 1.5%. Asia in the red, and you also have the SGX Nifty that's indicating a subdued start. Back to you.
Yeah, thanks a lot for that, Nigel. Not all that subdued. It's just about 0.1% down. And yesterday, in spite of the red on the SGX Nifty, we had a fairly green performance in India in the morning. So we have to see whether we are going to follow the Asian cues. To help us understand all that, Arvind Sanger of Geosphere Capital Management joins us, as does Richard Harris of Port Shelter Investment Management. Gentlemen, good morning to both of you, and thank you very much for joining us. Oh, rather, it's good evening for Arvind Sanger. Arvind, let me come to you first. What's your sense about how we have to read these slowdown signs emanating from the US bond market? Every now and then, there is a dash of red on the Asian screen, but the FII flows are so good into India that we overcome it. How much should an Indian investor worry about US bonds?
Well, I mean, I think U.S. bonds have in the past given a false signal about a recession. Obviously, an inverted yield curve is usually a precursor to a recession. So I think right now the market is assuming, and in my opinion correctly, that we are seeing global growth slowdown, but we are not on the verge of teetering into a recession. But, we've been, this is a recovery that's, over a decade old. So, about a decade old. So there is, always risk that at some point the cycle will end. And so the market's right to be nervous. But I think, to the extent that this is more of a moderate slowdown in US and frankly in Europe. I mean, it's not just US. Europe, bond yields on the German 10-year have gone negative. So you're seeing, global slowdown. And I think India is fine as long as it's a global slowdown and not a full-blown recession, because India does well when it's growing on a relatively attractive basis, and global liquidity is fine, which obviously with the Fed stopping raising rates, looks like liquidity is not a problem. So I think, to me, the Goldilocks for India would be no recession in US or Europe, easing of liquidity conditions by central bankers, both in Europe and the US. And India's growth by comparison looks even better compared to much lower growth in the West. So that would be the bull case. The risk is that if the West is going into a recession and we're 3 or 6 months away from that, then that's a headwind that the Indian market has never really outperformed on a sustained basis.
Okay. Arvind, good morning. So in that case, what's the bull case scenario for the Nifty? 14,000? And what would be the bear case bottom?
Well, I think, the bull case, clearly you can go up 20% from here over the next 12 months. And that, presupposes certain things happening in India, right? So it's not just about global factors, but it's about Indian elections producing a relatively, relatively stable outcome, seeing continued, economic strength. In fact, a recovery from some of the weakness that we've seen in some of the fundamentals that have been, that have been somewhat disappointing in terms of, auto sales, commercial vehicle sales, and other economic measures which have looked weak. The assumption is that that'll recover, and all of those can give us an upside of 20 to 25% in the Indian market if the economic outlook in FY20 delivers, reasonably good growth. We wouldn't look for fantastic growth, but 10 to 15% growth would give us that kind of outcome. On the other hand, the downside, it's hard to tell. It depends, frankly, on the depth of the global slowdown. And I wouldn't say, a bottom in Nifty would be only 10 or 15% from here, because we've seen in past global recessions that the sell-off in India and other emerging markets can be deeper than that, and that to some extent depends on on how bad the slowdown is. But again, our central case is very modest slowdown, but not a recession in the West, in which case we're more inclined to buy into weakness rather than be selling strength.
Okay, so you said that you can see a 20 to 25% upside in the market if the Indian economic growth story delivers, right? That's the operative phrase. Richard Harris of Port Shelter is also with us. Richard, good morning. There is a big slowdown in the Indian consumption story. We're hearing it from a lot of companies, whether it's Maruti in the auto space, Dabur in FMCG, or even the consumer durables. You've been tracking this India story closely for a while now. Would this bother you, or do you think that it's just a minor blip?
Sorry, I didn't quite catch the question. What would bother me?
The slowdown that we're seeing in the India consumption story?
Well, I don't really follow that as closely as I might. I mean, I think just in general terms, global terms, of course, we're seeing slowdowns in consumption everywhere, and that's really why we're seeing bond yields coming off. But apart from that, I can't really comment.
You want to come in on this? Because we have seen, you just mentioned that, it could be a minor blip. But what do you do with some of these names? I mean, they've come off a whole lot, whether it's the likes of Maruti or even Dabur talking about a big slowdown. Would you buy into the dip here?
Yeah, we would be inclined to buy weakness, but we also want to be, careful. We're not stepping into something where the slowdown is more than just a passing risk. And I really think that some of these consumption stories, have been going for a while. So one has to worry about, some of the FMCG space where the consumption story has been very strong for a long time. Stocks may have come off a little bit, but valuations aren't necessarily that attractive. We think that, the other parts of the story, the CV cycle or the auto cycle, probably from a, 3 to 5 year standpoint, India is still, as the income levels rise, has still a lot of room to go, and therefore we're more inclined to look at some of those areas where the consumption story is more stable, and frankly, some of the NBFCs that have obviously gotten hit, some of which are in essence plays on some of the financing some of the India growth story, and therefore some of those could be interesting as ways to play the same story.
Okay. Richard, how would you view India in this whole paradigm of falling bond yields and global slowdown? We continue to see good foreign flows into India. Is it that India is such a domestic story that in a context of global slowdown, you also will continue to prefer India?
Well, strangely, you put your finger on it a couple of minutes ago when you said that India often outperforms fairly difficult times. I think the emerging markets to a certain extent can still provide an element of diversification in the equity markets, whereas most global equity markets now seem to be really quite closely correlated. So I think that there's a possibility that India could continue to do okay. Obviously, if markets crash, if we are seeing recession elsewhere in the world, India is not going to be able to counteract that. But I think talk of recession is a very, very long way away. As they say, the bond market's predicted 9 out of the last 5 recessions. So there's no indication around the world that we're actually in recession in almost any economy, unless you go to Venezuela or somewhere like that. We have very slow growth, but we're not in recession. So I don't think we should be looking in those terms. I think we should be looking at a slower growth terms, and in that case, we will see rotation of money around the world, which is going to help emerging markets.
Okay. Arvind, of course, the next trigger for us is next week's monetary policy on next Friday. You reckon we are in for a rate cut cycling back in India?
Absolutely. I think given current Indian inflation numbers and given global easing of financial conditions, India clearly has one of the higher real rates in the world right now, and it gives the RBI a lot of room for continued easing. I think it's very likely. The only question in my mind is it going to be 25 or 50 basis points? But rate rising or rate cuts are not by itself sufficient for us to say, "Wow, let's go own the market." I think the real story we have to see is the financial condition tightness that India has seen with the NBFCs, some of them, having seen the cost of borrowing going up, as well as their availability of liquidity shrinking. Rate cuts will help, but I think we need more. Rate cuts are not a panacea, but they certainly are a helpful factor in helping the growth get back on track.
Okay. Richard, since, we're all optimistic on the Indian markets on this panel, what about the pecking order? Where does India feature on your list? I mean, does it rank higher than a market like China? And what would your outlook be for the rest of the year?
Well, I think in economic terms, it ranks significantly higher than China. And if you look at India's performance against China over most periods, okay, maybe not the last couple of months, but certainly if you go back a year, 3 years, 10 years, 20 years, India has eaten China's lunch if you're an equity market investor. But we are at an unusual time in China. The market's been extremely weak. Yes, we've just seen a pop of about 30%, but it's coming really from a very low base. So I think that there's room for China to outperform in the short term. But these things, once water finds its own level, once the markets find their own level, I think India is probably still going to appear to be a more attractive equity market overall on valuation terms than China. Although it's very difficult to ignore China, it's a very large market and important for us in this part of the world. I think I would probably look at India as having at least an equal weighting.
Well, finally, Richard, in that case, since you mentioned the word valuation, at any point would you be uncomfortable about valuations in India? All of last year, or at least late last year, when things were actually not going good, people kept pointing to India's higher valuations. It's not as if the economic activity has picked up, but no one's talking about valuations now because of the gush of money. At what point would you worry?
Well, valuations are quite fluky. People would often see 25, 30 times as being reasonable value, whereas at other times 10 or 11, they think it's too expensive. It's very much a relative indicator rather than an absolute indicator. I think if you're looking at valuations, what you really need to be looking at is what is the growth expected, what are the unexplained events that may happen. And especially what I tend to look at is second derivative growth. What is the growth on earnings growth and how expected is that? So I think that's more important than looking at raw, is it a high or is it a low PE? And especially in this environment where we've got interest rates moving all over the place, it's very difficult to value these things in that sense.
Okay. Well, Arvind, just before we end this discussion, I wanted your thoughts on how to approach the banks now. I mean, we briefly chatted about it, but, the index is at a record high. Stocks like Axis Bank, etc., are hitting new highs. What is going so damn right for the sector? And is it too late to jump in for retail investors?
Well, the banking space has benefited from the perfect storm, right? If you're a private sector bank, you've seen your major competitors, the NBFCs, get severely hampered, and therefore that's providing opportunity for banks to grow without having to take too much risk. Just customers, looking for options. I was talking to a, housing company, and they were talking about some of the customers relying on one of the housing finance companies that has run into trouble, and they were easily able to replace them with one of the major private sector entities. So that's clearly benefiting the banks, and plus you have easing interest rates, and you have the public sector banks, which still remain extremely constrained because of capital and because of balance sheets. So therefore, I think this is kind of a sweet spot for banks like the ICICIs and the Axis banks, which had lagged for a long period because of the bad loan problems, and that's behind us. So I still think there's room in these, but we're actually finding some of the NBFCs that have been extremely badly hurt to be a little bit more interesting. Those NBFCs had gotten very expensive, and we had traded off all of them last year, but some of them have come back to levels where I think that some of them are now trading at discounts to some of these banks. And yes, their growth will not be quite as heavy as before, but that is another area where investors should look at some of the higher quality NBFCs that have gotten sold off.
Okay. Well, you're getting bullish on NBFCs. I can see that. There's a lot of buzz on M&A activity as well in this space. So maybe it's going to be very interesting. Richard and Arvind, thank you very much for setting the stage and helping us understand how things are trending or going to trend from here. Okay, we also want to tell you that there are going to be some very big corporate voices on Bazaar. You're going to hear from Titan's CFO, S. Subramaniam. You're going to hear from the Bata CEO, Sandeep Kataria. They're going to join in to tell us how demand is looking like on the ground. KK Modi of Godfrey Phillips is going to be joining us to tell us about the cigarette industry. And as liquidity limps back to normalcy, or so we are told, we're going to take a check with an NBFC company, or no, more specifically, a housing finance company, that's Repco Home Finance.
Okay, big managements lined up, Titan and Bata, and the common thread between the two is both the stocks are sitting at all-time highs. We'll take a quick break on that note. Our list of top 10 stocks is lined up in just moments from now.